Gen AI through the programming of AI agents, accounting for complex financial instruments is another area. Welcome back, everyone, to another episode of Reporting Norms, the podcast that's dedicated to unpacking complex accounting issues clearly and practically. I'm your host, Norm Osumi, and today we're diving into a critical area impacting publicly traded companies, and that relates to financial restatements and material weaknesses. And as some of you may know, I've launched a newsletter called Zero Material Weakness, and it can be found at reportingnorms.ai. But in today's episode, I'm going to explore two key areas that I wanted to talk about. And I think this is a really interesting part of the financial reporting, accounting, and to a lesser extent, auditing. But they are what types of restatements occur most frequently and why? That's the first point that I'd like to cover in today's episode. And then the second point is, does every restatement mean that the company has a material weakness? We'll also discuss the implications for investors when both a significant restatement and a material weakness are disclosed at the same time. So what are the most frequent types of restatements? When companies restate their financial statements, it's usually because something significant went wrong with their original reporting. Based upon my review of the SEC.gov website using an API that was directly connected into my private GPT, I discovered that over the past 5 years, the most common areas of financial restatements fall into a handful of categories. And the first one is equity and temporary versus permanent classification. These errors by far are the most often errors that are found, and they affect how companies classify redeemable shares or preferred stock. And the equity section is sometimes can be a very complex area on the balance sheet. So these errors often occur due to the complexities involved in interpreting accounting standards such as ASC 480 and ASC 815. Companies frequently misclassify shares or apply incorrect methods when adjusting equity, particularly common among SPACs, which were more popular 4 to 5 years ago. Accounting for complex financial instruments is another area. Warrants, convertible notes, derivatives continue to confuse companies because misclassification, valuation mistakes, and understanding contractual terms, which can be buried in the term sheet and the deal summary, these can drive restatements here in this area, as these instruments require sophisticated judgment and a high level of technical expertise for sure. The third area is expense and cost misstatements. Whether incorrectly capitalizing expenses, mismanaging accruals, or errors in stock-based comp, these types of restatements remain frequent due to the misapplication of fundamental accounting concepts. But why do these types of errors reoccur so frequently? In short, the complexity and judgment are really the biggest reasons. The intricate accounting standards and subjectivity involved often overwhelm internal controls, especially in companies lacking sufficient expertise or robust review processes. This issue is also exacerbated by the fact that there is a general shortage of accounting professionals who may not realize that seeking deep expertise in these complex areas may be warranted. So given these current challenges, many companies are turning to Gen AI solutions to significantly reduce errors and enhance the accuracy of financial reporting. So how can that work? Gen AI, through the programming of AI agents with specific functions, can help automate and enhance the review process. For example, an AI agent can be used and it can be leveraged to identify advanced pattern recognition through NLP, or natural language processing. Additional specifically trained AI agents can also rapidly identify inconsistencies, anomalies, and common errors within the work papers before financial statements reach the auditors. Yet another AI agent could be programmed to analyze vast amounts of financial data quickly, flagging unusual transactions or deviations from historical patterns immediately, enabling quicker intervention and correction. And finally, another AI agent can improve compliance with complex standards through the use of advanced AI algorithms built into the agent that can assist accounting teams in interpreting and applying complex accounting standards such as ASC 606 or ASC 815, minimizing misclassification or valuation errors. So here's an example of a use case where an AI agent that is trained in complex financial instruments could be helpful to the finance and accounting professional. So consider a scenario where a publicly traded technology company regularly issues convertible notes and warrants to finance its operations. Very common over the last 4 years. These financial instruments require precise valuation and proper accounting treatment under ASC 15. Traditionally, the process involves complex spreadsheets, manual computations, and numerous assumptions that introduce the risk of error. So, by implementing AI agents, the company could automate and enhance this process with one or more AI agents specifically trained to ingest and review the financial data, contractual terms, and any other relevant market data. The AI agent will then leverage machine learning techniques to identify patterns and anomalies within the valuations, immediately flagging inconsistencies such as incorrect discount rates, volatility assumptions, or errors in amortizing schedules. And this data is would be connected through an API into the company's GL or other sources where the data exists such that the AI agent can read from. So these AI agents will then enable accounting teams to proactively correct errors, validate assumptions, and ensure accuracy before final financial statements are prepared and handed over to the auditors during a quarterly review or an annual audit. So, this proactive use of specifically trained and programmed AI agents not only improves accuracy, but also strengthens internal controls, reduces the likelihood of restatements, and ultimately protects investor confidence. And you can read more about this at my website, reportingnorms.ai, as well. So, going back to financial restatements, these are never pleasant for anybody, the accountant, the CAO, the CFO, the corporate controller, the revenue team, or any team that was impacted by the error. But why don't all restatements always mean that there's an associated material weakness? It's logical to assume that every major restatement implies a material weakness in internal controls. Major restatements, sometimes referred to as big R's. However, this isn't always true, and let's just clarify why. So, the big R restatement is filed when prior financial statements can't be relied upon. While still serious, companies must separately evaluate their internal control over financial reporting, also known as ICFR. Some firms refer to that as ICFR. I'll simply call it ICFR and talk about ICFR. But only about 45% of the big R restatements result in declaring a material weakness, while the majority, about 55%, actually don't. Some errors arise from isolated incidents, external factors, or changes in authoritative guidance where the authoritative guidance was correct initially, but the guidance changed, but the company didn't adjust the accounting to the new guidance. That happens from time to time, completely normal and under the course of normal business activities, especially for accounting for complex instruments. So, if the error isn't due to an internal control failure, no material weakness is required. Sometimes, even though an error occurs, the company's internal controls effectively identify and address the issues promptly. In such cases, auditors and management may judge ICFR as effective despite the error that occurred. Thus, a restatement usually triggers an intensive ICFR reassessment But the finding of a material weakness isn't automatic. It hinges entirely on the effectiveness of internal controls during the period under which the financial statements were being reviewed. So, switching gears a little bit, what is the market's impact when you have a combined restatement and a material weakness? So, when a company announces both a major restatement and a material weakness simultaneously, the market reaction tends to be particularly severe and negative. Studies show investors perceive this dual disclosure as especially negative, signaling, signaling deeper governance and operational issues. Typically, when both disclosures occur, investors fear underlying systemic issues rather than isolated errors. Empirical research consistently finds greater stock volatility and declines in market cap when both announcements occur together compared to when only a restatement is disclosed. And then, of course, there's market skepticism about the company that can persist even after the corrections are implemented, potentially impacting future valuations and the cost of their capital. So it really underscores the critical importance of robust internal controls, not just to avoid errors, but to manage investor perceptions effectively when problems inevitably arise. So, in summary, restatements are common and typically driven by complex accounting challenges for some of the examples that I stated earlier. However, there are many more reasons why restatements occur that I can get into in another podcast. However, they don't automatically mean a company suffers from material weaknesses in internal controls. When both issues do coincide, though, the market reaction can be swift and severe, highlighting the importance of transparency and strong financial governance. Thanks for joining me today on the reporting norms. This is an area of accounting that I find very fascinating and very interesting because the culmination of the company's processes, people, and systems really come together, especially when there is a weakness related to a error or a material weakness that arises because of an error and certainly more severe if there's a material error and a material weakness disclosed coincide with each other. You can also find more information in my newsletter, which is located, as I mentioned earlier, at reportingnorms.ai, where you can stay updated on matters related to financial reporting, internal controls, and regulations. And in many cases, I'll have guests on who can provide insight in their particular industry. So until next time, I'm Norm Osumi, encouraging you to stay transparent. So until next time, so long.